Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today's Friday. Thank God it's Friday. It's October 7th. I want to thank each and every one of you for sending me some wonderful wishes. Yesterday was my 21st wedding anniversary. Had a great night, went to a beautiful steakhouse, celebrated with my wife. It was wonderful. If you guys want to interact with me, please, it helps our videos. Post comments below, questions below this video in the WealthPress channel, and I'll actually respond to each and every one of them, as long as it's not spam. Anyways, let's get into today's session. And if you want to send me an email, support@marketgeeks.com. Now, the Dow Jones is up about 45 points. The NASDAQ is down 41 points. This is randomness. And one of the reasons we're seeing so much randomness is because we have a very big report today. We have the employment situation report. Yesterday's unemployment report, or the employment situation reports, showed that there are increased job openings, which is not that great. But on one aspect, you could look at that as giving the Fed more ammunition. And in one aspect, you could say that the Fed could use that as a negative sign that we're bending that into the recession needle too much. So again, when you see the range 220,000 to 340, they honestly have no clue. I would honestly look at the unemployment rate. It's a little more it's a little more solid, but this is going to be the last employment report or unemployment report or the employment situation report, whichever you want to call it, prior to the Fed deciding on the next rate hike. So this is a monthly, so it has a lot more weight. And the only report that's really significant after this that the Fed will use is the CPI. So this report is more important than ever because this is going to be used as a gauge or part of a gauge that the Fed is going to use to determine their or give us their reasoning for keeping rates elevated. So keep an eye on that. Let's talk a little bit about global economy, and then we'll come into all of the technical levels and all that good stuff we like to talk about. So markets are mixed ahead of U.S. employment data. Investors' hope will show that economy is weakening and persuade the Federal Reserve to ease off plans for more rate hikes. And this is what I was talking about. If the report is too solid, then the Fed will say, hey, we can, unemployment's great, people are working, we can keep bumping it up. But if the number is weaker, like yesterday's, it gives investors hope. So it's actually one of those reports where weaker data can cause a better rally than not seeing that kind of data. So again, it's one of those things where weakness can actually work in our advantage as opposed to the strength. The benchmark fell Thursday following a private sector report that said U.S. employees hired slightly more workers than forecast in September. That gives Fed ammunition that rate hikes are needed to cool the economy and rein in inflation that's at a 4-decade high. So again, it just depends on how they interpret it. And when Powell's in the house, don't even ask me. They don't interpret it the right way. What did they say? Pain. U.S. government data due on Friday. That's what we're talking about now. It's expected to show fewer people were hired compared with previous months. Investors hope that it'll persuade the Fed this year that are in scaling down plans for more. So again, it's one of those situations where negative news could really cause a nice rally, and we need a good rally right now because what the markets need is a pivot. They're crying out for a pivot from the Fed, especially with global economy contributing a lot to the downside in the last couple of weeks. The Fed and central banks around the world are focused on extinguishing inflation that's running at a multi-decade high, but investors worry that unusually large and rapid pace of their rate hikes might tip the global economy into a recession. The U.S. government data showed the number of applicants for unemployment benefits hit a 4-week high last week. That suggests that the job market may be cooling, and that's one of the reasons why the market turned around yesterday to the positive side. Because remember, weaker data, harder for the Fed to put more pressure on the economy. Forecasters expect the government report to show that we added 250,000 jobs last month, well below past year's 487 average, but that was really strong. But still a strong number despite inflation and 2 straight quarters of contraction, which puts us in a recession. U.S. crude oil, $89 a barrel. I think we're going back to 100. Now, a few interesting things that I want to point out to you. Utilities is right now making a multi-year low, and it's very cyclical. And if you notice here, the last 1, 2, 3, 4, 5 times we went down here, we bounced pretty hard. I'm expecting utilities to bounce off of these levels. I'm not expecting too much more downside. I think utilities may come down maybe to the 200-day, but we're very, very close to the bottom, at least for this run-up. And as you could see here, this is a 5-year chart. Whenever they come down to these levels, they tend to go up, and they've been deflated quite a bit. Now, you're probably asking, why are utilities down? Well, utilities is a double-edged sword. If interest rates go higher, right? Remember, utilities are dividend stocks. People buy them for safety. If interest rates are higher and you can get more money from government bond with less risk, you would put money there. That's one of the reasons. So inflationary pressure could be good for utilities, but recessionary pressure, that's a whole different world. So again, there's a big difference between recessionary pressure and inflationary pressure. They do well in a inflationary pressure, but they don't do well in a recessionary pressure. So again, very, very important. But again, in a recessionary pressure, you can argue that interest rates aren't going to go up. They're actually going to go lower. So this may actually do better in a worst case scenario where when they would do best when interest rates don't go up anymore, when they're actually going down or staying steady, but stocks have a potential to go higher. So I think we're in that category right now because I don't think the Fed is going to go much higher on rates. And I think the market will cool off based on that and start moving higher, or heat up based on that and start moving higher. But I like the fact that utilities are at a 5-year support level. We may initiate some positions based on that. You do have earnings. You had earnings yesterday on Constellation, Levi's, Conagra. Forward-looking statements are not good. They're basically doing everything possible to protect themselves. And today we have Tilray. Now, Tilray, it's very interesting because there is a higher exposure on these type of smaller stocks right now. Matter of fact, if you look at the ARK stocks, they've been congesting. They have not been going down. Now, looking at volatility still peaked a few days ago, and from where I'm sitting, it's moving in the right direction. And I think if the news today that's coming out in about 10 minutes is on the negative side, maybe 240, 210,000, then the market could potentially rally because it would signal that the Fed can't really do much more. Now, on a 1-month basis, you've got energy, healthcare, financials, basic materials. Notice that information technology, consumer discretionary starting to cool off, and they're next to each other again. Well, wait till communication services is there too. Expect consumer staples, expect utilities to start coming up, and information technology, consumer discretionary, and communication services to keep coming down. Looking at 20-day breakouts, and this is really important because this gives us a short-term view at momentum. They're heating up, but they're heating up in both directions. You're basically getting a lot of stocks making 20-day breakouts and a lot of stocks making 20-day breakdowns, which just confirms that we are, in fact, in a choppy market. But if you look at the Dow, you will see that makes quite a lot of sense. The key is, are we going to fall back down to this area, or are we going to consolidate and start coming up? If you look at the QQQ, it's already in that range. You see that? And if you look at the SPY, you will see we're already in that range. So from where I'm sitting, I think the odds are higher that we're going to go higher back into this range, and that bonds are actually going to come up instead of down because we're in a great oversold level. And as you can see here, they're not having an easy time. I mean, yes, we are in a downtrend, but they're not having that easy of a time coming down as they did over here. So to me, it looks like they may be consolidating and ready to move higher once again. Now, remember, folks, today we talk about algos. Now, algos are great right now. You know why? Because some of my algos are based on pullbacks, and people are scared. And when people are scared, they start second-guessing their strategies. With algos, you don't have to second-guess your strategies. With algos, you could trade consistently knowing that you have an edge in the right direction. Now, I'm going to be having a class today at 1:30 p.m. I usually don't do them at 1:30. I usually do them at the top of the hour, but today I'm doing it at 1:30 Eastern Time. And I'm going to educate you about algorithms and how they work. You can ask me questions. We'll talk about it. I'll explain which algos are hitting it, which ones are not, the upside, the downside, everything you need to know about algos. So don't miss out. Follow the link below this video. Now, let me continue. I want to give you guys some more value. I want to talk about the top stocks right now. If you look at the S&P 500, you will see that you've got a broad base now, but a lot of pharmaceuticals. You still have a lot of the energy stocks, but you have a lot of, here's the energy, but you're starting to get a lot of the Las Vegas Sands, Wynn Hotel. That's telling us that the going out crowd is coming back. Twitter's now number one, but again, pharmaceuticals, energy, pharmaceuticals is where it is right now. Now, my suggestion is to focus on those sectors. Utilities may not be the worst sector. In terms of the weakest stocks, you've got Charter Communication, CarMax, FedEx, Intel, Dish. You know how much I love Dish. I hate this stock. I hate this stock. But again, same ones. Comcast is here right now, and other communication companies. Be very cautious with these companies that have been on the 52-week low because they don't seem to be moving higher. Meanwhile, you're having really good stocks like Marathon, Lamb Weston, Albemarle, Unum, Regeneron, Hess, Conoco, Devon. Wynn and Las Vegas Sands, I would be very, very cautious right now. I would be very, very cautious. But the fact that they're going higher means that economy is actually strengthening and COVID is behind us. So that's not the worst sign that these stocks are starting to come up. Genuine Car Parts still looks good. Occidental. So again, medical stocks and energy stocks are it for the time being. Now, before I let you go for the weekend, and please post comments below the video. I really appreciate it, and I do respond, and I learn from it. I know what to do. I get questions. It's great. So, folks, here's what you need to know. Monday, Tuesday, we saw the biggest two-day rally in the SPY since March of 2020. Oh, yeah, it's like that. And that's why I'm going live today at 1:30 p.m. Eastern Time, 1:30 p.m. Eastern Time on Friday, to show you exactly how I use algorithms to trade, simplify trading, to make it easy without having to second guess anything, especially when markets are this volatile. Specifically, I'll cover 5 entry signals every trader needs to have their eye on in the coming weeks. They're not complicated, and you don't need fancy trading platform or to be glued to your computer all day. Join me 1:30 p.m. Eastern Time, and I'll show you exactly the rules of these 5 entry signals. Now, this special training session is free to attend, so you really have nothing to lose. Simply click the link below to reserve your seat and get the link for today's session. Do it now. And again, YouTube channel, Wealth Press YouTube channel, follow, check it out, do it now. I'll talk to you guys soon. Have a wonderful, wonderful weekend. Bye. Take care.